For my Go See It project, I decided to consider the Chipotle Mexican Grill Company, one of the most successful fast casual restaurants in the world. Chipotle Mexican Grill combines delicious Mexican flavors with fresh ingredients, creating a restaurant thousands of customers flock to around the world every day. Because Chipotle Mexican Grill is a publicly traded company, I had the opportunity to look into their financial statements online. Today, we're looking into their property, plant, and equipment account of the balance sheet, which Chipotle actually calls their leasehold improvement property and equipment account. To start, I'm going to go over a summary of what PP&E is. It is property, plant, and equipment. It is discussed in Chapter 9 of our textbook and in thorough detail online and in many other accounting classes around the country. PP&E are a company's non-current assets that are used in the process of doing business. They can be anything such as land and buildings, motor vehicles, furniture, office equipment, computers, fixtures and fittings, plants and machinery, anything and everything. PP&E assets are not sold directly to a company's customers. Property, plant, and equipment is a term that describes the account on the balance sheet of the assets above that I said earlier. The PP&E account is a summation of all a company's purchases of properties, manufacturing plants, and pieces of equipment to the point that in time, less any amortization or depreciation. Amortization or depreciation is used to devalue an asset as the asset is used over time, and is designed to measure the asset's economic value through its useful life. The balance in this account is remeasured every reporting period due to amortization deduction or depreciation deduction, but the balance displayed depends on a few separate determining factors. To enter a balance into the PP&E account, a firm must find the historic cost of all the assets first. Historic or purchase costs are the initial cost the firm paid for securing the use of this asset. If, for example, a company purchased a factory for $10 million, then the historic cost of this factory is $10 million. Historic costs are equal to the nominal purchase price. Once the historic costs are determined, the depreciation can be deducted over time, and the balance is called the book value is entered into the account. At Chipotle, their 2015 annual report shows that their leasehold improvements, property, and equipment are recorded at cost. Internal costs directly associated with the acquisition, development, and construction of a restaurant are capitalized were $9,554, $7,756, and $9,024 in millions for the years ended in December 31st of 2015, 2014, and 2013, respectively. Their depreciation is calculated using the straight line method that we learned in class actually, over the estimated useful life of the assets. They then go in to say that they consider the estimated useful lives of their assets as the following: leasehold improvements and building between 3 and 20 years, furniture and fixtures between 4 and 7 years, equipment between 3 and 10 years. Every company accounts for PP&E in many different ways, and it was really interesting to see the way that one of my favorite places to eat does it. Thank you for listening, and that is my Go See It project.